In the first 6 months of 2025, the US dollar didn't just stumble, it fell. It dropped by over 10% against the world's major currencies. They tell you it's just an economic cycle, but the numbers, the statistics, tell a very different story. Today on StatSphere, we are not talking about opinions. We are talking about data.
Welcome to StatSphere. Don't forget to like, subscribe now, and activate the bell for our latest videos.
But before we show you the 5 shocking numbers behind the crash, we must first look at one number, the most important number that explains why this matters to every single person on Earth. 1. The 60% privilege. Why do we even care about the dollar? Because it is the world's reserve currency. But what does that mean in data? It means that today, nearly 60% of all money held by the world's central banks is in US dollars. It's the default currency for oil, for international trade. It's the universal ATM. This gives the US what is called an exorbitant privilege. Because everyone needs dollars, the US government can borrow money more cheaply than anyone. It allows them to run huge deficits. This entire system is built on one thing: confidence. When that confidence cracks, the privilege fades. And when the privilege fades, the system breaks. The 2025 drop wasn't just a number. It was a sign those cracks are getting wider. Now, for the 5 numbers that are causing the cracks. 2. The economic rot, the $38 trillion monster. The first and most obvious number isn't the crash itself, it is the debt. In late 2025, the US national debt crossed the $38 trillion mark. To put that in perspective, that is now over 120% of America's entire annual economic output. This isn't the only sign of rot. The American exceptionalism story was built on a strong job market, but the 2025 data shows fragility. The unemployment rate ticked up to 4.3% in August. Even worse, non-farm payrolls added a measly 22,000 jobs. Hiring has stalled, and the American consumer, the engine of the economy, worn out. Savings rates are low, and credit card debt is at an all-time high. A stalled job market, a tired consumer, and a government drowning in $38 trillion of debt. This was the tinderbox. 3. The Federal Reserve's trap. Because the economy is weak, the Federal Reserve is trapped. They had to act. They cut interest rates in September and again in October to try and create a soft landing. But for the dollar, this was a disaster. For decades, global investors chased the interest rate differential. It's simple. US bonds paid higher interest than German or Japanese bonds, so money always flowed into the dollar. But as the Fed started cutting rates, that advantage began to disappear. Other central banks, like the European Central Bank, held steady, signaling more confidence. This narrowing gap was a massive red flag. Suddenly, holding dollars wasn't the obvious choice anymore. The trap was sprung.
4. The 70% collapse of confidence. A currency is not just math, it's faith. And in 2025, that faith shattered. A shocking 2025 survey of central bank reserve managers, the people who manage the world's money, revealed the true damage. 70% said they were hesitant to invest in the dollar specifically because of the US political climate. This number has more than doubled from just 1 year before. Why? Constant budget fights in Washington, threats of shutdowns, and relentless political pressure on the Federal Reserve attacking its independence. When the people managing the world's trillions lose faith in your politics, you have a structural crisis. 5. The great capital flight. So what happens when the economy looks weak and the politics look shaky? Money leaves. The data on this great rebalancing is brutally clear. Let's look at Part A. Part A, the S&P versus emerging markets. Let's compare 2 key indexes. The US S&P 500 index rose about 18% by the fall. Not bad. But the iShares MSCI Emerging Markets Index, it soared by 30%. Money wasn't just leaving the US, it was running toward new growth. Part B, the rise of the euro. It wasn't just emerging markets. Money also flowed back to Europe. As US politics looked chaotic, the European Central Bank held a steadier course. The result? The euro gained about 13% against the dollar over the year, hitting its best exchange rate since mid-2023. Investors were not just selling the dollar, they were actively buying its chief competitors. 6. The 2,000-ton escape route. This leads to the final and most powerful data point. If central banks are losing faith, point 3, and private money is leaving, point 4, what are they all buying instead? They are buying gold. In the 3 years leading up to 2025, the world central banks bought a staggering over 2,000 tons of gold. Let's be clear, this isn't speculation, this is a long-term strategic shift. They are literally trading US government bonds for physical gold bars. Why? Because gold is the only asset that isn't controlled by any single country. It is the ultimate neutral asset. This isn't an investment. This is central banks building an escape route. 6. Conclusion. The vicious cycle. So what do these 5 data points tell us? They show us a dangerous, vicious cycle has begun. Here's how the loop works. First, deep economic weakness, the 38T debt, the stalled job market, forces the Fed to cut interest rates. Second, those lower interest rates mixed with the 70% collapse in political confidence trigger capital flight. Third, the capital flight to Europe to emerging markets causes the dollar's value to tank. Fourth, and here's the kill shot, a weaker dollar makes all imports more expensive. This fuels inflation back home in America. And fifth, that new inflation makes the economy even weaker, forcing the Fed into more cuts, which starts the cycle all over again. The 2025 crash wasn't one event. It was the sound of these 5 data points. 38 trillion, the Fed's trap, the 70% crisis, the 30% capital flight, and the 2,000 tons of gold, all colliding at once. The era of the dollar's easy supremacy is being repriced, and the data is finally catching up to reality. Navigating this new world requires understanding the data behind the headlines. If you believe in the power of numbers, make sure to subscribe to StatSphere and hit that notification bell. What other data points are you seeing? Do you think this cycle is reversible? Let us know your analysis in the comment section below. And don't forget to like this video if you found this data valuable. Thanks for watching.